On to your markets news now. Asian markets ended the session mixed today, this following a lackluster performance on U.S. markets the night before. Investors were said to be cautious, taking in the news that Chinese authorities plan to effect more proactive fiscal measures while also loosening monetary policy into next year. But the escalating conflict in the Middle East continues to weigh on market sentiment. The Nikkei share average ended the session up 0.53%. The Hang Seng Index declined by 0.5%, while the Shanghai Composite Index closed up 0.6%. U.S. markets ended yesterday's session on a subdued note. Nvidia shares declined on the back of a Chinese anti-competition investigation, while investors awaited the latest inflation report, which is due out tomorrow. The expectation remains that the Fed will cut rates on the 18th of December, but big question marks remain as to whether that will be the case going into the new year. The Dow Jones Industrial Average declined by just over 0.5%. The S&P 500 lost 0.61%, while the Nasdaq Composite Index was down 0.62%. All right, we check in on the indicators right now. Currently, we see that the all-share index is trading up by 0.5% at 83,749 index points. When it comes to the currencies, we do see the rand trading at 17.87 against the US dollar, 18.89 vis-a-vis the euro, and 22.83 against the British pound. We see that the currency has weakened a little bit as the session has progressed, following its firming yesterday against major currencies. And of course, we look at the commodities. We see that the gold price is trading at $2,667 an ounce, platinum at $945 an ounce, while Brent crude oil is trading at $71.90 a barrel. Well, for more on the markets, I'm joined by Martin Smith. He's a portfolio manager at Anchor Capital. Thanks very much, Martin, for joining us. So why do you think markets were a little bit subdued over in the United States yesterday? And of course, there is a big question mark about U.S. equity valuations as they stand right now, because we've just been hearing all-time highs, for much of this year. And the question is, if you were to invest right now, what sort of return would you get? Is the bubble set to burst?
I mean, that's the golden question, right? And I think what you've seen yesterday is maybe the trade that we've seen post-Trump, which was a lot of kind of price appreciation across the board, has just run out of steam a little bit for now. So maybe you're seeing a little bit of profit taking, a little bit of consolidating, because as you've mentioned, valuations are very high and the market is looking very expensive, but expensive for 12 months. So I think people are just being a little bit cautious after the run we've seen in the last month or so. Whether it kind of goes from here remains to be seen. You can see a kind of slow melt up, but investors are definitely very, very cautious because valuations are very, very high.
It looks like the Chinese authorities are willing to throw everything at improving the economic fortunes of that country. I mean, it said they're even prepared to increase unconventional counter-cyclical measures in dealing with the economy. What exactly does that mean?
It means they're basically trying to get their economy, which is struggling, going again by doing monetary policy as well as a little bit of fiscal policy. But the thing they're speaking about really is the fact that for the last 14 years, they haven't really touched their monetary policy since the global financial crisis. So they really are trying to stimulate that economy because it's just struggling to get going for the better part of 18 months or so. So they're using some monetary policy for the first time, like I mentioned, 14 years, as well as a little bit of fiscal policy as well. So interesting to see, because this is now probably the third or fourth bit of stimulus that we've seen from the Chinese government in the last couple of months. So the market liked it that side, but let's see if it continues.
Yeah, we see how that plays out into 2025. So the local currency firmed up very nicely yesterday, but we see that losing a little bit of steam today, weakening a bit against major currencies. The question is, the firmness that we saw yesterday, how sustainable is it? And of course, when we see what happened today, it looks not very sustainable.
Yeah, it's tough. I mean, from a technical perspective, this kind of 1780 is quite a key level. If we can get through that, then 1740 is the next one. I think what we did see is, again, back to the Trump story. When he came in, the dollar strengthened quite a lot. And you also had emerging markets being a bit weaker given his kind of rhetoric on tariffs. So you have those two things leading to a weaker rand. But now as you see that Trump trade unwinding a little bit, or maybe just catching its breath a little bit, you're seeing a little bit more appetite for emerging markets. So how sustainable, I'm not really sure, but hopefully we see a bit of positive momentum into the year end, because December is often a very kind of relatively strong period for the rand.
Yeah. You touched on it earlier. You talked about profit taking. I think this is probably going to be the last really serious active week that we see, and just before the 16th of December, at least in the South African context, at least. What do you think is going to happen? Are people going to profit take? Are we going to see a slowdown in the markets? Until people decide to come back next year?
So yeah, you're 100% right. We generally see very, very low volumes kind of after the 16th of December every single year. I don't anticipate that being not being the case this year in South Africa. US markets do also stay open though, and it's a little bit less of a quiet time on that side. So you definitely have to keep a close eye on it. But as far as South Africans concerned, volumes go pretty much very, very low, and people enjoy their break until the 1st or 2nd week of January.
All right, Martin, thank you very much for your time and insights as always, and we'll speak to you next year. That was Martin Smith. He's a portfolio manager at Anchor Capital.